A stock's dividend yield is an estimate of the investment's dividend-only return. If the dividend is not increased or decreased, the yield will increase as the stock price falls. When the stock price rises, it will decline, and vice versa. Dividend yields fluctuate about stock price. Thus, they can appear exceptionally high for stocks that are rapidly losing value. Hi guys, welcome back to Glory Investing Show. And in today's video, I'm going to tell you about the top 6 monthly dividends ETFs to earn income in 2022. The WisdomTree US High Dividend Index is a fundamentally weighted index that measures the performance of companies and high dividend yields selected from the WisdomTree US Dividend Index. By purchasing shares of this ETF, you're automatically giving yourself targeted exposure to the highest dividend-paying stocks in the US stock market. For example, out of the 315 stocks that this ETF currently holds, some of its top holdings include companies that you'll likely recognize, such as Pfizer, Cisco, Verizon, AT&T, and Coca-Cola. And because this ETF holds some pretty solid companies, it also means that the performance is also pretty good. Over the past 10 years, DHS has given an average annual return of about 11.57%. This means that if you would have invested $10,000 into this ETF 10 years ago, your investment would have grown close to $30,000. SPHD is based on the S&P 500 Low Volatility High Dividend Index that measures the performance of the 50 least volatile, high dividend yielding stocks in the S&P 500. This index was designed as a benchmark for investors looking to earn income from their investments. And because SPHD was designed around the index, it's pretty safe to say that it's a really solid choice for your dividend portfolio. SPHD currently holds 51 stocks in total, with top holdings in Iron Mountain, ExxonMobil, and some other potentially less familiar companies. This ETF was founded in 2012, which means that we can't look at the 10-year performance of the ETF. However, since its inception, you can see that this ETF has had a yearly return of about 11.3%. This means that $10,000 back in 2012 would be worth a little bit over $23,000 today. Again, considering that this is a high-yield dividend ETF, it really is impressive to see that your investment will experience good capital appreciation on top of the high dividend that you're receiving every single month. And speaking of dividends, this ETF will pay you a monthly dividend of 3.86%. The fund and the index are rebalanced and reconstituted semi-annually in January and July. This ETF is a market cap-weighted index designed to measure the total return performance of the fixed-rate US dollar-denominated preferred securities market. Now that sounds pretty dang confusing, but it just means that PGX only invests in shares of preferred stock. Preferred shares are a special type of stock that pays a set scheduled dividend that's very similar to a bond. However, they're unique from bonds in that by owning shares of a preferred stock, you still have ownership of or part ownership of the company, whereas with bonds, you don't. Preferred shares of stock are also known for paying out higher dividend yields when compared to common shares of stock, which is what 99% of retail investors invest in when they're investing in the stock market. PGX currently holds 301 preferred share issues with top holdings in Citigroup, JP Chase, Wells Fargo, and many others. Over the past 10 years, PGX has returned about 6.73% per year. This means that $10,000 invested into the ETF 10 years ago would be close to $19,000 today, and on top of that, you'll also earn a dividend yield of about 4.7%. The expense ratio on PGX is slightly higher, coming in at 0.52%, which means that you'll pay $52 per year on $10,000 invested. And because this ETF invests in only preferred shares of stock, it does carry a little bit less risk. This one DIV invests in low volatility and high dividend paying stocks within the entire US stock market. DIV holds 50 of the highest dividend yielding stocks in the US, with top holdings in CubeSmart, Public Storage, Pfizer, and others. This ETF was founded in 2013, which means it's relatively new, and so we can't track its 10-year performance yet. However, since its inception in 2013, it's given an average annual return of about 4.67%. While the growth of this ETF is a little bit slower than the other ones on this list, what it lacks in performance it makes up for in its high dividend yield. DIV has a dividend yield of 5.80%, which is the highest one on this list so far, but it's also bordering the line of having a high expense ratio, coming in at 0.45%, which means you'll pay $45 per year on $10,000 invested. I think it's a pretty fair assessment to say that some of the other ETFs on this list could potentially be better investments when compared to this one. However, the main criteria for ranking these ETFs on this list was the dividend yield, and so the higher the dividend yield, that means more money in your pocket each month. It has a higher expense ratio, but it also has a higher dividend yield, and that's why it falls higher on this list. This is a very similar ETF made by the same company as DIV with a slight twist to it. The difference with this ETF is that instead of investing in 50 of the highest dividend yielding stocks in the US, it invests in 100 of the highest dividend yielding stocks in the world now. The actual number of stocks that the ETF holds currently sits at 104, with top holdings in China Power International, Yangzhou Coal Mining, etc. Over the past 10 years, this ETF has only returned about 3.10% per year on average, which means that $10,000 invested 10 years ago would be worth only about $13,600 today. And so even though your $10,000 investment is not losing value, it's still not growing as much as it would be. SDIV currently has a dividend yield of 6.83%, and like with all the ETFs on this list, it does pay a monthly dividend. In terms of risk, because this stock invests heavily in international stocks, which often exhibit greater volatility than US stocks, this ETF has an expense ratio of 0.59, which is definitely on the more expensive side. That means that you'll be paying $59 per year on $10,000 invested. Now we have the last ETF on this list, and that is KBWD, or the Invesco KBW High Dividend Yield Financial ETF. This ETF is based on the KBW Nasdaq Financial Sector Dividend Yield Index, which is a dividend yield weighted index consisting of U.S. financial companies with high dividend yields. That is usually engaged in the business of providing some type of financial product or service. That could be something like banking or insurance loans, or something along those lines. This ETF only holds about 41 stocks with top holdings and some names that you'll likely not recognize. All of these are financial companies that provide financial services and products. It's still a relatively good performing ETF, especially for something that pays such a high dividend yield. The current 10-year average sits at about 8.75% per year. This means that $10,000 invested 10 years ago would have grown to around the upper $19,000 range. However, where this ETF shines and why it sits at number 1 on the list is its super high dividend yield, which currently sits at a juicy 7.37% according to Invesco's yield performance details. However, that yield comes with the price, and that price comes in the form of a significantly higher expense ratio than all the other ETFs on this list. With a 1.24% expense ratio, that's more than double the cost of the most expensive ETF on this list, SDIV, which had an expense ratio of 0.59%. And that's all for today's video. I hope you enjoyed it. If you found this video helpful, make sure to smash the like button and share it with your friends. Don't forget to share your thoughts with us in the comments section below, and while you're here, click to watch one of these other 2 videos appearing on your screen right now. I'll see you there. Take care and stay tuned.